What's up YouTube? Welcome to the Wallet Monkey channel, where we give you all the tools and intel you need to grow your wallet. Walletmonkey.io, check it out. It's got a ton of credit resources, you know, the elusive master lender list, and all kinds of really just great data points and information for you to make the most best educated decision that you can in terms of credit applications and you know, growing your wallet. So I think this is actually the first time we've done a face reveal, so big dramatic music effects. Welcome to the channel. So I don't know why I didn't do it sooner. I guess I was waiting for 2000, so that sounds like a good excuse, so we'll go with that. So yeah, now we can kind of see each other face to face. Expect more videos like this. We've got some great interviews coming up, collaborations coming up, and things that I'm really excited for. So thank you so much for everyone that's been supporting the channel over the last couple months. It's been growing exponentially. I love it. This is why we started doing this. I've talked about that at length in the past. Our goal and our job here is to just aggregate data from all over the internet to give you the best single source place of information to, like I said, make decisions on growing your wallet. So today, long-winded, I know, today we are going to cover 11 reasons that your credit card application might be denied. So in this video, 11 reasons why your credit card application was denied. Let's jump into it. Okay, so there is a laundry list of stuff. Some of these have changed in terms of importance based off firsthand data over the years. And so I'm kind of putting these are in order from most important to least important, okay? That doesn't mean that you ignore the bottom half and just focus on the top half. And I know that you're gonna be probably familiar with at least 3 or 4 of these things on this list, but just bear with us as we go through the whole thing, right? All right, so bad payment history. This is by far the first and biggest thing that is gonna stop you from getting new credit and getting denied. Now, this has changed because, like, for example, if I just grab one piece out of DROG's, lates, BK's, bankruptcies, collections, etc., it would be bankruptcies, and that isn't as bad as it used to be. What they really want to see now is that you've got, most banks, they want to see that you've got 12 months of on-time payment history before they kind of start to say, yeah, that doesn't matter. 3-4 years, it really starts to not matter, especially if you're following some of the other things that we talk about on the channel, and maybe you've set yourself up with some authorized users or AU accounts. You've got some secured or unsecured cards already with a few establishments, and all that payment history over a 12-month period is looking good, and it's been 12 months since the BK was discharged, then it starts to matter less. But I put this as the number one reason is because it still is the biggest. And if you don't know those tricks that I just gave you and you're going in blind, then you're really gonna get denied. Yeah, you know, at the core, a bank wants to know that they're gonna get paid back, right? And they want to know that you're going to be good on the debt. So there's 2 things that matter the most: is, are you paying on time, and are you making any money? If you've got your, you know, I guess this is a little sidebar, but if you've got your income at like 10K, 5K, 2K, 0, you got no work history, no previous jobs listed on your credit report or anything like that, you're going to have a harder time, right? Number 2, too much debt. So this equates to 30% of the pie, if not more, on the FICO pie. I'll probably cue that up. What we're looking for here is there's 2 factors. There is utilization, which is what all bureaus go off of, but mostly all banks go off of this as well. Credit unions tend to go off of something which is DTI, so let me break down both. A utilization is just how much of the total limit, we've got a 5K card, how much are we utilizing? How much of a rolling balance do I got on my revolving credit line, right? So if we got a $5,000 card and we're using $500, then we're at what, 10%? And if we're at $5, we're at, you know, 1%. So they just want to know what percent of utilization you're at across all of the accounts, because there's also another little trick that you can do, which is I think called A0 or something like that is the term in the FICO forums. Is basically like you pay off all the balances on your cards except for like 1 or 2, and those 1 or 2 cards can have a high utilization, meaning you can have 70-80% of the card balance used, because it doesn't really matter. The weight of all the other cards not being used at all offsets the 2 that you're using regularly or carrying a balance on, right? There's a trick like that, but just understand that in general, all they're really looking at is utilization across your TCL, total credit limit. Yeah. Now DTI is debt to income ratio, and this is actually a percentage. You can go and look this up, and you can use a calculator. You can understand exactly what they're looking at. But it's like, in general, it's 30% is what I'd say, because it's like 34% for a mortgage, and I think it's like 30% for a credit card, and DTI is mostly used at credit unions, as I mentioned. So I'm just gonna say 30% across the boards. Now, if you're dealing with a very conservative credit union, and they've deemed themselves to be very conservative, or you're reading on the FICO forums or watching a video from us, that's saying that, understand that a very conservative in their eyes is probably like 24%, maybe even 20% of DTI. So that is how much am I making and how much am I paying out per month. That is based on a usually 12-month period. So they just want to know monthly what you're making. So they want pay stubs or something. And then how much are you paying in credit card payments every single month? And then they take those two numbers and times by 12, and there's your DTI ratio, okay? So pretty simple. Another thing that's beautiful about DTI is that it's in relation to how much money you make. DTI affects somebody who's making $1 million a year just as much as it affects somebody who's making $30,000 a year. I think that's relevant to mention is because like the debt number is in relation to what you're making and what your balances are and you know what you owe essentially. Okay, I think you got it. Number 3, credit history is too short. Now, in general, this means two different things, okay? A thin file, meaning that there's not enough open accounts, right? So maybe you got 2 accounts, 3 accounts. People with new credit, people with repairing their credit, they run into this problem all the time, is that the file itself, the entire profile is too thin. And this is a term that you'll even hear within the industry and people using it. It just means that you don't have enough open accounts, revolving, installment, etc., right? Now, the second part of that, to credit history being too short or the file not being good enough, right, is the history not being long enough. So AAOA is average age of account. And if that's less than 18 months, you're going to start to really get some eyebrows perking up during the underwriting process, okay? Which most of the time, if you're dealing with a credit union, you're dealing with an underwriter. Whereas with a big bank, a lot of times it's an automated system, it's getting approved in bulk or disproved in bulk, and a lot of automated or automatic triggers are being triggered for good or for bad. So that's why we use reconsideration lines with the big banks, right? Average age of account, less than 18 months. Again, you're going to start to run into problems. None of what I'm mentioning is a hard and fact. 100% of the time, every credit profile is different. I've heard some wild stories about people with what would be deemed as a bad credit profile or a thin credit profile get a ton of new credit all the time, get approved all the time, right? So it's like, it really doesn't matter, that aspect of it. Again, this is just a rule of thumb, right? Okay, so the next one is if you find yourself impulsive and you just can't stop it, like you go to walletmonkey.io and you check out all of the recent pre-approval offers, which there's like 30 or 40 pre-approval offers that we've got on one page, and you're seeing all these pre-approval offers, maybe you just can't help yourself and you go and you try and submit a bunch of applications at once. Or you're just coming off the back end of what we call a game day, but what you've probably heard of is what's called an app spree. It just means that you take a day and you submit a bunch of applications and you get a bunch of new credit, whether it's in one day or a week or a month. But if you've got 4 or 5 new accounts reporting on 1 or 2, let's say 3 statements or less, then you're going to start to get denied because they're starting to think, what's going on here? Are they chasing bonuses? Are they needing credit? Because remember, the adage is that banks don't like to give you credit when you need it. They like to give you credit when you don't need it, okay? And they really don't want to give you credit when you need it. Say that 5 times fast. Okay, so basically, it's a big red flag for when they see this, okay? We are at number 5. This, we're getting into the more granular stuff. So we've now crossed over the threshold of like what everyone's probably heard into the stuff that, oh, maybe I didn't know that. How much total credit limit, TCL, you have, and keep in mind that is most important with credit unions, as I've mentioned before. So what they start to look at is you got $100,000 in credit cards. Now you could make $200,000 a year, documented and stated, right? For a lot of credit unions, that's still high risk because that's like a 1x of essentially your income. And they don't like to approve 100% of those, right? They want to maybe look at other factors, look at the age, look at, some of the stuff we've already talked about, right? Understand that if you've got like $100,000 in credit cards and your utilization is like 1%, you're going to start to get head scratches at not just credit unions, but big banks. Because they're like, why does he want more credit? Maybe he's just farming credit. Maybe he's just, again, chasing sign-up bonuses, or who knows what he's doing. But if you've got access to all this credit already, $100,000, and you're only using 1% of that, why do you want another card with us? And so the bank starts to ask, like, do we really want this as a customer? Because it doesn't even really look like they're using it. And the bank's got to make money. There's a couple facets and ways that they make money off of a credit card. Yeah, and interest being paid is one of those. So yeah, they are definitely going to be starting to ask that question. Okay, next, let's start to fly through these. How many credit cards you already have? Okay, so this is specific to the bank or institution itself. So here are some, in case you didn't know, is that Discover will allow each customer 2 credit cards. You can't get a new credit card until after 12 months. Max you can get is 2 cards per user. Now you can get business cards, you can go that route, you can get personal loans, or I think they got lines of credit still, lines of credit, other products, but within the revolving credit card area, you can only get 2 with Discover. With Amex, you can get 4 per user. That's a change that they rolled out in 2020. Navy Fed, you can get 3 per user. And again, we could go through the entire list, but with most banks, they have a cap. So that means you can only get a certain amount of cards through that bank. And after that, that's it. So again, if you've already hit that peak or that maximum and you didn't know that they had a maximum, then you're gonna get denied. Okay, income too low. This goes into and kind of touches on to what I already covered, is that they want to get paid, right? And so if you've got $30,000, $40,000 income and you start to get $25,000, $30,000, $40,000 in credit card total limits, then you start to run into an issue where you're going to get denied, because they're thinking, okay, but wait a second, he's making 40, he's got access to 40, maybe that's a flight risk for us, right? It tends to work in reverse, right? Like if you're younger, it tends to work to your advantage, because they're like, oh, well, he's just coming out of school. Like we hear all the time, Navy Fed Credit Union is giving out, 18, 25K credit limits to like an 18-year-old kid who has no credit whatsoever. Part of that's DTI, but part of it is the fact that with how they're weighing out their, let's say, their decision-making underwriting process, is that this guy's got a life ahead of him to pay us back. And so they take on that risk as a good thing. Whereas when you get older, they start to take on that risk differently. So if you're older and you have low income, how is this older person going to make more income is how they start to question it. Whereas when you're young, you're vibrant, like he can pay because he can just keep going and getting new jobs. If you're retired and they know it, or if you even stated on the application that you're retired, you've stated on the application, we're jumping into the next one, that you're on Social Security or disability of some sort, those are kind of red flags. And what I mean by kind of is I've seen those stopping people from getting approved that I've personally tried to help. Okay, so the next one is, yes, if you're putting on your application that you're pulling Social Security or you're getting Social Security of some sort, you're on some sort of disability, you're retired, if you're putting that on your application, denial is like all but imminent in those situations, because they're not even really caring about what your income is at that point. They're just wondering what happens if this goes away and how are you going to pay the debt. So again, it comes back to paying the debt. Self-employed and hard to verify income. This is true. These next two, we'll group them together, even though I've got them listed as two separate things, is verifying any information on your credit profile. That could be your address. That's a very, very common one, that if there's some sort of mismatch, or if they're going to run you through like 3 or 4 questions about your history and you answer any of those wrong, then we can start to see rejections and denials happen, right? And then if you put down that you're self-employed and maybe it's not showing up on your credit profile like a W-2 would or a job would, then maybe they start to pull back in terms of instant approvals. Maybe they want more documented income, POI, proof of income, something like that, pay stub, something to prove that yes, you're actually making money with your business. Understand that self-employed, unless you can provide documentation, is typically frowned upon more than a job, because the job most likely, as I said, is going to be showing up on your credit report anyways, so they're okay with that. And then the last one I want to talk about, I used to think this mattered more, but recently I'm not so sure, is that there's these secondary, let's call them subprime bureaus, okay? And this is how the CFTC labels these. This isn't me labeling them. Okay, this is the government doing that. Okay, so these are 3 subprime bureaus that you have the same game to play with. So we've got to pull the reports, we can freeze those reports, we can dispute things on those reports, and sometimes they're showing up soft pull inquiries and they're showing up hard pull inquiries that you got rid of on the major 3, but they're showing up still on those secondary. And yes, that does affect your ability to get new credit. And like I said, is it as much as I used to think? No. So I don't really know where to place this, because it's not like I've dealt with a huge sample size and a huge data set to be able to give you that. I just know that it does affect. And it's something that, it's not that hard. They have to give you one report for free every single year, every single one of these bureaus, and the primary 3, Trans, Equifax, Experian. So look, you might as well just pull the report and see what it's saying. And if there's things in there that you don't like, or if they're showing inquiries that you've already gotten removed through some sort of means on your primaries, then maybe it's time to start looking at that and getting that cleaned up, or at least freeze them so that they can't give data to a bank on the back end, right? So anyways, that's all I got for you. Comment below if you got questions, you just got something to say, or you just want to help us with the algorithms. You know the game. So it requires commenting and it requires liking. So if you could just do one of those things or both, it's completely free. And that helps out the channel grow and helps us grow this community, right? So if you're brand new here, a lot of our viewers actually are not subscribed. Crazy, I know. Take a second, hit the red subscribe button, hit the bell notification, be on the lookout. More videos coming soon. All right, see ya.